I thought in this video it'd be good to give a little bit of investing advice. I often see people saying when they get involved with something which is decidedly risky, they say, look, take a punt, take a bet, take a stake, take an investment, but only invest what you can afford to lose and make sure as soon as you've got your money back, you withdraw that initial investment. Now on the surface, that seems like really good advice. However, it doesn't make any logical sense, and that's what I want to run through on this video. So let's take a hypothetical high yield investment program, an HYIP, which by the way are all scams, but let's say you're going to invest $1,000. You can afford to lose $1,000. You've been told by someone else that go and invest what you can afford to lose, $1,000, because the returns could be brilliant. And let's say they quote you a monthly return of 20%. Now they may do it on a daily basis, saying 1% per day or 20% per month or whatever, but those are your typical. There's a massive warning siren there for you straight away, because if you do the calculations on 20% per month, if you could manage to achieve that, you would solve the world's financial crises within about 30 years, if not shorter than that. So always be really, really cautious of anyone where they're saying, yeah, look, we can make 20% a month. If it's trading, you might be able to do that for a little while, but you will get a massive drawdown at some point. If it's not trading, it's actually just supposed trading, it's probably a Ponzi scheme, it's probably a scam. So be very cautious of that. But that's the first point. But assuming that was possible, assuming you could get 20% per month, let's just have a look at some example figures. Now, the first example, like I said, the person tells you withdraw your seed capital as soon as possible, as soon as you can. So month one, you put in $1,000. A month later, you've gained 20%, so you've now got $1,200. Third month, you've got $1,440. Oh, and by the way, at this point, they'll also tell you about compounding your money. Leave your money in compounding. So you've got this conflicting idea. You've got to compound your money, but take out your money as well. Well, that's not compounding your money, but that's by the by. So month four, $1,728. Month five, you've got $2,074. So at this point, you now doubled your money. You can withdraw your $1,000 initial seed capital. So you take away the $1,000 from the $2,074, you got $1,074. Give a 20% growth on that again. At the end of month six, you're at $1,288, and so on. At the end of 24 months, just for ease of fitting it on this chart and making it simple and being 2 years, a lot of people don't seem to be able to take long-term investment views these days, seems to be my view. But if you took it for 24 months, you would have grown your $1,000. You'd have taken out your $1,000 on month five. So you've had nothing to risk whatsoever. You've now got $34,299. So in total, you've withdrawn $35,299. That would appear to be absolutely fantastic. You've got extraordinary results at 20% per month. You've got a huge return on your money. But like I said, 20% per month is not realistic anyway in the real world. But if that's what you were convinced you were going to get, that's the sort of return, and that's what you would see people quoting, saying, look at this huge return, you know, take your seed capital out, there's no risk. Very, very attractive on the surface of it. But let's look at that logically. If you really genuinely could get 20% per month, then why on earth would you take out your initial seed capital? Because you want to use the power of compounding. So let's look at what would happen if you left your investment to maturity. In other words, left it there for 2 years. So you invest your $1,000, consider that spent money. You don't know if it's going to work or not. You've spent that money, you've purchased it, you've gone for that. You put your $1,000 in month one, month two, you got your 1,200, and so on. After 24 months, your account has grown to $66,247. At that point, you withdraw it. So if you were convinced that you were genuinely investing in something that was 100% legitimate and could give you, and it doesn't matter what the percentage is, whether it's 20% per month, 1% per month, 0.1% per month, it doesn't matter. This is the point I'm trying to make. What matters is that you shouldn't withdraw your seed capital if you are going to be genuinely investing. And this is a good test for you. If you feel uncomfortable about investing money in a scheme, then you shouldn't put any money in that scheme until you've got proof that it's genuine. They're either genuinely trading or they've got a track record or something like that. And if you have, you go and take a calculated risk. You are risking money on your investment, but you don't then say, I'm going to withdraw my initial investment if you're going to try and compound that money. That doesn't make any logical sense whatsoever. And you can see in this example, you have missed out on $31,000 by withdrawing your $1,000 back, by taking out your risk money and saying, no, I'm no longer on risk. You've missed out massively on what would have been potentially a life-changing return. And this is what compounding is about. It's about having the long-term view, staying in there, calculating your risk in the first place. A lot of people underestimate or overestimate what the risk is and underestimate how much they can afford to risk. You know, any money you have today, you have got that. Unless it's inherited money, you've earned your money, you've been given your money, whatever, you can go and do that again. Unless you're very much later in life and it's your life savings, then obviously you don't go and risk something like that. But most people overestimate the risk and underestimate how much they can actually afford to risk. As long as you're not biting into your daily, monthly bills and your food supplies and things like that, then actually I think people should be taking higher risks when it comes to investments. When I say higher risks, I don't mean they should be just putting money in things they haven't investigated, and that's part of what I'm trying to get across in this video as well. Make sure you investigate your investment first. The best thing you can possibly do is make sure you properly third-party research any investment opportunity that's presented to you. Make sure it's genuine. If it is, then you can probably afford to take a bigger risk than you may realize. If you're thinking, well, I really don't know, I'll have a punt, I'll have a go, then you shouldn't get involved in the first place, in all honesty, because you're likely to lose all your money before you get to month 5 or whatever the point is when you want to withdraw your seed capital, which is so often talked about as the risk-free way of doing it. It's not. You're still risking that money, and most HYIPs, not most HYIPs, every single HYIP I've ever seen has been a Ponzi scheme, and all Ponzi schemes collapse, and they usually collapse very, very quickly because most of them don't gain traction, and the people who create those close them very early. Those that do go on longer term, what you might find by the time you got to month 5, you think, I've doubled my money. Why would I take my seed capital out now? Because then that's going to really impact my investment. So most people don't actually withdraw their seed money, and in a Ponzi scheme, most people end up losing money. Anyway, that's my rant over for today. Hopefully you found this video useful. Feel free to give me any comments, any thoughts. Love to hear them. Thanks for watching. Do subscribe to my channel, give me a thumbs up, and I look forward to seeing you on the next video.